Yo, what's good, everybody? Welcome back to another section in the Day Trading Institution course. So the first things first, I want you guys to take everything lesson by lesson. Take your time, really try and soak in all the information possible. Even if you finish later on, I want you guys to kind of come back because you could probably pick up on things that I missed up before. So anyways, in today's lesson, what we're going to be going over are pretty much the principles of trading. So what we're going to pretty much cover in this lesson is how you can implement a casino-like strategy, how to find your winning edge, looking at the probabilistic side of trading along with managing your trades. So anyways, most of you guys are probably familiar with what a casino, I'm sure, everybody is familiar with what a casino is. But what we're going to be going over is how you could trade as similar to a casino as possible. Now, I don't want anybody to skip through any portion of the course because all these analogies are super important. So later on, they could start to click in terms of, what we can all do together in this learning process on how we can actually apply everything that I'm teaching you guys. So when I talk about trade like a casino, I don't literally mean trade as if you're an actual casino. What I mean by this is all we're simply going to be doing is looking for the probability and understanding what probabilities actually are, because trading is not a game of 50-50, even though there's either buy or sell, because there are probabilities and there are certain things that do come into account when we're actually looking to trade. So everybody knows what a casino is. Everybody is probably familiar with what this table is, which is going to be roulette. So now, first things first, as you can see, the casino automatically has an edge over their gamblers. Now, you want to think about trading as gambling and you want to be the actual casino. So you have to ask yourself, how can I be the actual casino and how can I adopt this mindset? How can I apply this to my trading, right? So you being an actual casino, then everybody else in the market is a gambler, because we know the statistic that 90% of people within the market fail. Why? And that's just because mainly due to gambling. A lot of people can't seem to find the discipline and are really trying to get rich quick. And that's very similar to what the casinos are. A lot of people probably say casinos are a quick way to get rich, right? But now what we automatically have with this table in roulette, now I'm pretty sure, most people when they look at this table, they probably have the impression that this is a 50-50% chance of winning, 50-50% chance of losing, which is obviously not the case. Now, how the casino built their edge, where they have an increased edge of about, let's just say 5.2% over their gamblers, is by simply adding this green here. Now, the payout is a 1-to-1 per se. Let's say you were going to bet on black and black actually hits, you get paid out a 1-to-1. You were bet on red and red actually hits, you get paid out a 1-to-1. Now, the issue comes for the gambler is that they don't have a winning edge as of right now. It's not even a 50-50. The gambler's probability is a 47.4% chance of actually winning. Why? And that's simply because of this green color right here. The casinos obviously added this color because they would be probably broke or losing a lot of money due to it being a 50-50. So the casinos ask themselves, how can we have an increased edge over our gamblers? And it's simple, by adding the green color into the scheme. Now, obviously, green doesn't pay out a 1-to-1. I believe it pays out like a 1-to-7, 1-to-14, something like that, right? But we're not here to learn about roulette. Anyways, so now if we take a look at things, right, first things first, we have black. So there's going to be 18 black, there's 18 red, and there's 2 green, right? So if you were to look to make a bet, and let's say you wanted to bet on black, the casino doesn't have a 50-50. You don't have a 50-50 chance of winning because the casino has 2 more chances of beating you here. So if it doesn't land on red and it doesn't land on green, then that's when you would win. But notice that the casino has 2 chances to actually beat you here versus you only have 1 chance no matter what you bet on, right? And that's just how the casinos built their edge. They're always going to have an edge over their gamblers. Now, obviously, the gamblers get lucky, right? And they may actually, hit whatever they were betting on, but the casino's always going to have that 5% edge, keeping them profitable in the long run. Now, let's move on to the next subject, right? So when it comes down to trading, trading is all a game of probabilities. you never want to associate trading in the words like 1000% or 100%, along with, I know the market will do this, or I know the market will do this and then do that. You never really know. You want to adopt the mindset that you don't know what the market is going to do, and we're only trading based off of probabilities. So keep in mind, probabilities will never be 100% correct. You're never going to be 100% correct in the market. Now, there may be times where you may feel this way, and especially when you're in a winning streak, your confidence is very high. So what tends to actually happen is traders at this point in time will start heavily increasing their position size, and then they start getting a little bit of losing streaks, right? Or they start entering a little losing streak. They lost 2 trades in a row. They'd be like, all right, you know what? I'm actually going to double up on this trade because I'm pretty sure I'm going to win this one. Typically tend to lose when that's not the case. We want to be able to manage our risk and really understand that trading is actually just a probabilistic game, and we have to approach it with this probability mindset that you're not going to win every single trade. You're going to learn patterns and everything later on throughout the course, but just because you see these patterns, it doesn't mean it will 100% play out. Now, again, you have a higher probability, right? You as a trader need to determine what your high probability setups are versus what a low probability setup is, and then manage your risk accordingly. In your high probability setups, you probably want to use a heavier position size than when you have a low probability setup, because again, the odds are more in your favor for it to play out. But just because the odds are more in your favor for it to play out doesn't mean it will. Just like the casino has a 5% edge over their gamblers, it doesn't mean that the casino is always going to win every single time. They're going to have that loss eventually, right? So your job as a trader is to determine if a trade will actually be, or will actually have a high probability based on X, Y, Z reason, which those reasons we're going to get into later on throughout the course. But we're going to be determining things such as price action, indicators, news events, whatever the case might be. Is again, your job as a trader is to determine if that trade has a probability that is higher of the trade actually playing out in your favor. And this is something that's determined by your own technical analysis. And you can obviously add things later on, like if you want to add fundamental analysis, but typically we're going to be looking at this and we're going to be basing our probability based off of our own technical analysis and what we see that could play out in the market. Now, again, one thing I really want to emphasize is just because the probability is in your favor on that specific trade doesn't mean that you're going to win that trade. This is why risk management and practicing risk management is so important, because this is what's going to keep you alive during the losing streaks. You don't know how big of a losing streak you're going to have. You could lose 6, 7, 8 trades in a row. Again, winning streaks and losing streaks, they come in waves, right? So you're going to have a wave of winning streaks that may be 5, 6, 7, 8 trades that you win in a row, but then maybe, you lose 4 or 5 trades in a row, then you win another 8 trades in a row. And it's literally an entire trend. Like if I could just draw it out for you, having a winning streak and a losing streak will literally look like this, right? And this will be your winning streak right here. And then your losing streak will come in and start to diminish some of these profits before you have another winning streak, right? Let me draw that a little bit smaller. So let's just say that this is your actual winning streak right here. This entire equity in your P, or this entire equity curve in your P&L is what your winning streak is. And then your losing streak looks something like this, right? And then obviously we play the long-term game, right? So this is what your equity curve may end up looking like over a period of trades. Right now, I'm not saying 10 trades, I'm not saying 20 trades, I'm talking about hundreds of trades. That was what your equity curve will look like. There will be hard times in trading and there will be amazing times in trading, right? Trading is something that is really going to test your emotions and really test your psychology, because you need to be able to show up to the market every single day, no matter how many trades you've lost in a row, and complete your technical analysis to the best of your ability, to your peak performance. And there's going to be days where you're not going to be able to perform like you performed, the last few days. Maybe you're a little bit burnt out. Maybe, you have a lot of problems going on in your life that you're a little bit stressed, and that's going to affect your trading. And there's a lot of outside stressors that will definitely affect your trading, but you got to keep you got to keep the overall picture in mind that you're playing the long-term game here. This is how you're going to be able to survive this through risk management. Now, don't get me wrong, trading could be a lot of fun, especially, when you're making a lot of money, you're going to be excited to show up to the market every day. But then, at the same time, when it starts going bad, trading could definitely turn into something that's very stressful. You may have a lot of stress, you may have a lot of anxiety. Again, we're humans and we all go through these emotions, and money is a very sensitive topic for, I want to say, the majority of people, right? A lot of people make decisions, poor ones and good ones, based off of money. And these are just, the side effects, I guess, of being a trader. I don't really want to say the side effects, but that's just in your job description. You have to be able to hold yourself accountable, because I'm not going to hold you accountable if I say, hey, you're trading like you're gambling, right? I can't hold you accountable to that. You have to hold yourself accountable to that. But just understand that you will have losing trades. Just don't let those losing trades discourage you. Like I've always said, the only traders I feel are the ones that quit. Right? Now, let's go over an example of what a high probability trade actually looks like here. So what I'm gonna do, let me try and figure out how I'm gonna plan this out here. So what I'm gonna do is I'm gonna draw some fake market structure here, right? Okay, so now I'm not gonna get too in depth here, because we haven't really even gone over market structure or anything. But what I'm going to simply be doing is talking based off of price levels. So let's actually kind of take some time to do this drawing here. So what I'm going to do is I'm going to draw one level. Let's just leave it right here. Right? Actually, let's undo that. What I'm going to do is I'm going to draw a level here. I'm going to draw a level here. Right? And let's just say, let me just kind of continue this here. Right. So now what I'm going to do is put this here, and let's just say we're trading gold again. I'm just going to use gold as an example because that's the currency pair that I trade the most. Let's say it's 1800. Let's say this is 1750. And then let's say this up here is 1850. So now let's say that you're taking a position here, and you've seen time and time again, whenever price hits this line here, 1800, whenever you see price or the market hit this 1800 line, it completely rejects and moves in the opposite direction. You're looking at previous market structure, and you see that there is a level of supply and demand here. Now, again, the market moves based off of supply and demand, and market moves off of volume. So already, right? Trading is based off of supply and demand and based off of volume, right? So you've determined already that every time prices hit this level, it's rejected and moved in the opposite direction previously. Notice how here it rejected and went down. It rejected here and went down. It rejected here and went up, and rejected here so far. Now it's going down. So you make the hypothesis, okay, well, if price is actually trading at 1800 now, right? And we've actually broken under this level of structure and we've started trading lower, what's the probability of price to continue to go down versus to continue to go up? Now, I'm not really adding in here any other factors such as, candlestick analysis. I'm not adding into any other factors, maybe such as Fibonacci, or I'm not adding into, indicators, but you want to look at all those things, right? Let's say your indicators are also telling you sell. You have already 3 things that are telling you to sell. One of your indicators is telling you that no, there's a higher probability of price is going to go short right now. You have a level of supply and demand, and you have the multiple rejections already. This is a major level of structure. So you've already identified that you're going to want to go short because the probability of price to continue to go down is a lot higher. Now you have to actually map out your actual trade. Now that you want to go short, you have to tell yourself, okay, where am I going to get out if I'm wrong? And that's something that you have to identify before you actually enter the trade. Let's just say you've identified that you want to get out at this price right here, 1852 is where you're going to cut your loss. Because again, we're going to be wrong, right? So if price actually does come up to 1852 after your entry point, let's say you took an entry right here with this red markers, if price does come up to 1852, you've already identified that you're wrong on that trading and you want to cut your loss short, you're going to cut it right there and there at 1852. Now you have to ask yourself, okay, where am I going to get out if I'm right? And that's going to be 1750. Why? Because every time price came down near 1750, it had some consolidation or it decided to actually reject and move the opposite direction. So that's where you want to get out and take your profits when you're actually right. And I can look at things like I can incorporate risk management, I can incorporate risk reward, but I just kind of want you to identify or really take an example of what a high probability trade looks like. We have multiple confirmations that price is most likely going to go in our favor. We're simply just going to wait for our entry point. Once price actually gives us our actual entry, we're going to take the trade. And it's as simple as that. You're not taking trades for no reasons. You want to have an if and then thought process. Well, if price can reject 1850, then I'm going to be looking for price to reach 1750 and trade lower. Now you have to ask yourselves, why is that? You always want to ask yourself, why do you think that price is going to continue to go lower? Well, market structure has actually broken to the downside. We've pulled back to a previous level of supply and demand, and price held as resistance. It's as simple as that. What you've done for yourself is you've built yourself a high probability trading setup. And again, you can incorporate things like the trend and everything else. But really, I kind of just want to keep it simple as of right now. So anyways, hopefully you guys didn't really understand this section. This is definitely a video that you can come back to in the future. That'll definitely help you guys out a lot once you get a better comprehension of what trends and market structure and everything actually is. And hopefully you guys are benefiting off of this as well. And I'll speak to everybody in the next section of the course.